Okay, we have started, and it is November 14th. Tomorrow's the Ides of November, and it's 2024, as you know. And I'm Tim Quast with Market Structure Edge, and this is the weekly demo and discussion. We've got only two rules. If you would just mute yourself during the discussion, you veterans know that. If you're new, that's really our only rule. And number two, ask us questions. Please feel free to interrupt. You write in the chat. If I'm talking, Henry will be watching that, and vice versa. And we'll try to answer those, or just interrupt us. We don't mind at all. Okay, with that preamble, then let me introduce Henry Howard for the first day. He's head of client services, and one of the he was like user number 4. So he knows a great deal about this platform. And so, Henry, I will hand it off to you for part 1.
Great. Thanks, Tim, and welcome everybody. It's great to be here. Yeah, I will mention, one of the things, so I generally write our Wednesday desk note. If you write into the live chat, I'll be there. If you're having an issue accessing your account, I'll be there. Yeah, Tim, you're right. I was early on, and what I sometimes forget for new users is that it's great to go back to the basics. It's very helpful to go back to sort of the standards of Market Structure Edge. So I'm going to go ahead and jump in here, and I'm going to walk you. I have a very, I consider myself a discretionary trader, but I'm informed by algorithmic data, and I have some pretty hard rules that I have in place. And one of those is just my daily process is to walk through the Market Structure Edge data, walk through broad market sentiment. So our first priority today is to walk through those things. I'm going to get here sharing my screen. We've had a wild week. And now I'm sort of focused on what's ahead, but I'm going to start by just walking through my daily process. So this is the Market Structure Edge dashboard. And so the very first thing, I've added a new portfolio up here. Obviously, you can add new portfolios if you go here. But the first thing I'll start with is broad market sentiment. So this is our State Street S&P 500. This is what the market is doing, and this is what a large majority of the trading activity and behavior. This is where it's happening, and so this is the very first thing I'm tracking every day. I'm looking up: is this broad market sentiment? Is it bottoming, and is it getting ready to move upward? And to what degree is it moving upward? I wrote the desk note yesterday, and I saw this thing move from 5 to 5.4. That's a great positive move, knowing that we have short volume here. It's all in the context of, we'll get to context about our options expirations. But the point is, I'm checking where this green line here is our sort of, below the green line, below 4, it's really high statistical probability that the market rises there. When we have this sort of strong bottom, so as some of you know, last week I said, we might have a good week. We might get some selling by the end of the week. None of that happened. We had just, I think I was watching the futures as they started to count ballots out here on the East Coast. And boy, did this thing just run up overnight. But look at this, in this broad market, we have this bottoming. We can see sort of this stability in the market. And then as we get to the red line up here at 6, we start to know that the potential of returns is starting to deteriorate. There's another little clue that I'll show you in a moment. But again, we have our green line and our red line, which are just, those are our general boundaries. And I'm looking at the degree also to which this line is moving. And then, we have the daily move as I follow on short volume. These are each day is just the purple line, each dot. And then what's really, I think helpful is to look at this trend in short volume. A lot of this move here, and this stability in the market here is really off of short selling. And we're going to talk about that a little more. So the next thing after I look at broad market sentiment and short volume is I look at our momentum portfolio right here. And I look how many companies are in momentum. Yesterday it was 43. I can't remember a time, even as being user number 1, Tim, that I can remember that there were more than 43 components in momentum. So again, it speaks to
very unusual. Yeah, have over 40 maybe happens twice a year at most.
Wow. Exactly. So that I go, wow, that's, we're getting up there. But I also, when I see those anomalies, I don't go too headlong, especially around options expirations. I go, well, there's an outlier right now. So what else is happening behind the scenes? And then before I get to it, I'll say we check low volatility. This has shifted. A week ago, I think we had a ton in low volatility, and now it's all shifted to momentum. So you can see, just this massive risk on in the market. There's an appetite for upside. There's an appetite for volatility. And that's what really these momentum and these low volatility portfolios we've gone over. Why are they populating like that? It's because of their volatility. It's the time that they've spent up at 10. And we're making this we're distinguishing between the low volatility and the momentum. So those are the two that I check. The number of components, obviously, in momentum. When I saw this morning that momentum is now down at 39, that actually starts to tell me that, wow, that portfolio is now waning. We're entering options expiration, which is, that gives me a sort of, raise a red flag of caution. So that's step number 2. And then what I like to do is, so much of the market is predicated on big tech. And what we know through market behaviors, and what I think Brian mentioned this morning, is passive behavior. Is a lot of this passive money is just chasing a midpoint of an index. And so the reason I like to look at big tech is it's responsible for such a large portion of market cap. So in here, if I go to our big tech portfolio, I can sort here by market cap, and obviously Nvidia is on the top. But what I like to look for is an alignment of these components. So I can see it visually that everything's moving up, right? But I'm also looking to see, are these moving together? Because they tend, if they pull one direction together, they tend to pull another direction. So obviously, we have relatively low short volumes in Microsoft and Amazon. We can see that graphically again, that even though this is moving up, we still have some of these really big names. I mean, those are relatively low short volumes for all of those names. So it just speaks to needing to be very familiar. So like Tim said, I've dug through this data quite a bit, maybe more than I'd like to admit. But it's really important. I wrote in my desk note, I said, take your pick. Taking your pick means finding something that you're very confident in, and finding something that you're very familiar with. And so it used to be that we didn't actually have all the functions on Market Structure Edge that we do now. But the last step of this process is to go and look, once I've evaluated the direction of the market from sort of a broader top-down perspective, that's when I go back to the dashboard. I'll pull up daily trading ideas. I like to sort by probability. Yesterday, there were fewer names in this. Tim and I talk about this when we're on the desk. It's like, what are these names? And not to get too biased, but just understanding, what are these names? Is there some consistency in these high probability names in sector? Is there some consistency in market cap? And how do we take advantage of that in the context of broad market sentiment and broad market short volume? So those are the 3, primary steps. Obviously, I don't spend a ton of time in low volatility until I see low volatility, like the numbers and the number of components in low volatility explode. Then I might take a look at it and look a little more as to why that is and what names are in there. Sometimes it's an indication if low volatility is getting occupied by names like Google or some other sort of mega cap names. So back to this momentum, that's how we sort it. Let's dig down now, and I'm going to talk about how do we, evaluate an individual name. Well, the nice thing is these probabilities we used to not have these probabilities. You have to go to something called Profiler, which Tim, he said, yeah, we don't touch on Profiler a lot. So I actually brought up WBD. It just looked so good too yesterday, and it's doing pretty well. So WBD, we have our probability. Now, is it a guarantee 100% probability that's going to go up? No, it's looking back the last 90 days. What has been the behavior under these conditions? Under these conditions, WBD 100% of the time in the last 90 days, when it's under these conditions, it's gone up. So we understand that it's probable that it's going to go up again, because the market's not some mysterious, it's not so mysterious. We understand that money follows things. And so that's how we measure it, is here in our probabilities, in our entry and exits. So I'm going to hop over here. We're going to look at the actual, the visual look, the graph of WBD. And obviously we have sentiment hitting 10. We have this long-term downward trend in short volume. And then, after I look at what does short volume look like, what does sentiment look like, I'll hop over and I'll just say, where are we in the morning? Well, obviously, Warner Brothers had been up, the couple days before, it had been sort of just inching down, some people say consolidating. But what I saw pre-market is, man, this could be a potential entry point. So let's look at the entry points on WBD. Obviously, we have, I'll have to pull it up on our daily trading ideas. It's not in daily trading ideas where we get the entries and exits. The point is, we know that somewhere around here, if we have, a low of 9 and a high of 940, somewhere in this middle point is going to be a pretty, of the last few days, we just drew a line down the middle. We know 920 is going to be a pretty darn good entry point on that morning when we have a high probability. So that's a look at how do you use, we get this all the time. How do you use edge on a regular basis? Well, we know the market loves midpoints. Everybody's using VWAP. It's only reliable to the degree that I look at edge and say, yeah, this is a high probability trade, or broad market and short volume are, aligned in the correct way. So that's how you use sentiment and broad market, and how you look at an individual name for an entry and an exit. This is from yesterday. So we had 972 as the last close. You have this range of entries and exits. That's for today. If you looked yesterday, it was actually lower. So the next thing I want to do now, and I can pause there if we have any questions. Excuse me, I'm going to drink some water. We can pause there. I don't know if there's anything in the chat yet, or specific names that you guys want to talk about. But sharp to time. Okay, so let's look at Profiler, and I'm just gonna I'll end this and then I'll lob it back to Tim. In Market Structure Edge, you have this thing called Profiler. Now, in addition to being able to look back, we can change the date here. We can look back a few months at what the behavior of under these conditions of WBD and individual names. We can do that for any stock. Under Profiler, what we're able to do, we can actually set date boundaries. So in this case, I'm looking back the full year. I'm looking back year to date. So this is back in January, the beginning of the year. What Profiler does is really sort of intuitive backtesting methodology. You say, well, what happens? I sort of have four options. I say, when are we going to buy it, and when are we going to sell it? Are we going to buy it on an uptick? Are we going to buy it on a 1? Or the default is 5. So we're going to buy on either a 5, an uptick, or we're actually going to buy ones. Well, there's some issues with buying ones. They're quite a bit more risky. We've ran the data. 10s are much more reliable. But sometimes, I tend to use ones when I have a really confident level in adding something to my portfolio and we know it's going to bounce. So that's the entries, sentiment buy threshold. The second part is sentiment sell threshold. So if I buy WBD at a 1 and I sell it at a 10, what we can look at is the returns based on if we're trading it or if we're buying and holding it. So obviously buying at 1 over year to date, if you bought it at a 1 and sold over this period, you're down 21%. Well, if you buy the 1 and you sell it on the 10, you actually are now 65% gain, and you're only in the market out of the total trading days. You're only in the market about half of those days, a little over half. Let's see if change that sell to 5. Excuse me. If you sell it, if you're buying at 1 and selling at 5, those returns go down. Let's see, what if you bought it at 5 and you sell it at 10? That's a little more comfortable, but point is, oh, WBD, when it gets over 5, the returns diminish a bit historically. So if I'm looking at WBD, I'm wanting to see that tick upwards. So let's see, buy the uptick, sell the 10. Again, what I'm really looking for is I'm buying that. I really want that down. I want that sell the down tick. So there's 51% in just 111 days. So my point in showing Profiler is it's very, very helpful to become familiar with a number of names. I said in my desk note, run NVIDIA, run Apple, run Google, run those big names, because the market's going to move with those names. And the more familiar you are with those names, the more familiar you are with this data, the more confident you can be in your decision making, which I think it's, half of it's just your confidence going into these trades. So again, looking back at WBD, and I think Tim mentioned this, I'm not looking to get this whole move. I'm really looking, to see this thing bounce off of this and hit the open. And then I'm only looking for 2.5%, 3% of these higher volatility names. I'm not trying to capture the whole thing. I have a perspective on what the daily volatility is, and you just do a little bit at a time. I'm still not in a position where I hedge my, I don't hedge my individual positions. But again, that's a good way to. I think Tim might talk about hedging positions because he did it last week. But again, we're just trying to take a little bit at a time. We're taking the highest probabilities. We're aligning broad market sentiment, understanding what the biggest components in the market are doing, and then following that. So I'm going to take one more beat there. The last thing I wanted to mention, which I think Tim will cover this as well, is recognizing this move from, we knew out of the election, the data actually looked pretty good going into the election. When we see a real, a market run up of about 4% in 2.5 days, that's a stretch for the market. And so knowing that within the context of daily volatility and what we should expect from the whole market, we really early in this week, we knew that it takes a minute for the market to catch up. So again, using daily volatility to see where the market is at, where individual names are at, and then picking your spots just to know, especially going into context of options expirations, that now, the money was to be made, last week. I don't think going into option expirations right now, it's just there's more risk than we want to sort of consume at this time. So I've blabbed on for long enough. I'm sure, errors and omissions, Tim, I'm sure you have a number of them. But yeah, go ahead.
All right. Thank you very much, Henry. Appreciate that. I'm going to share my screen, which will knock you off, I think, Henry. So beware of that. So there we go. By the way, can I do this? I think I'll show you something. In case you didn't know, using Teams, yeah, it will only show up on your side. So you will see a button up here that says pop out. Do you see that button? If you click that pop out button, it's not there on my side because I'm sharing my screen, but if I'm watching, then it gives me that button, and it makes the screen much larger that whoever's presenting is sharing, and so it's really helpful if you're struggling to see what's occurring. That pop out feature works really well, and then you just close that window and it will return to this one. Okay, so here's what I want to talk about. Depending on how much time we have, I want to talk about the basics. As I said before I started recording, I went and counted. I just ran a report. I use Interactive Brokers, so I ran a transaction report to see what I had traded and how often I had traded it in just this week. And I have executed 45 trades, and there sometimes I'm building positions by buying things a little bit at a time, and I look at those sorts of things. Here's how I think about this. So suppose that I'm going to the daily trading ideas, and I'm going to just cover entries, exits, stops, and limits first. and when I like to buy and sell things, and then we'll come back to a couple of other things about the basics here. But so today I traded Lyft. I actually bought it yesterday, and I like to do that. Frankly, I like to buy things basically in the last 10 minutes of a day. And it all depends. And I follow this data. I do. I know that I have a 7 out of 10 chance. I got a 71% chance of making money. Also means I've got a 30% chance of losing. I have to keep that in mind. But it's a very good probability. The probabilities, as Henry said, are not perfect, but it sure beats guessing. I mean, what else are you going to use? How many rich technical traders do you know? I've said that as a joke, but it's in many cases, it's very similar to betting on things. How many rich gamblers do you know? Well, there aren't very many. Most people lose money gambling. And the fact is, most people lose money trading equities because they're getting an edge, getting an advantage in the market is very difficult. It's just a fact. Math is a huge help. So when I'm looking at Lyft, I know already that it has a propensity. This is basically a 5-day average. There's a 5-day average of a 5.7% move between intraday high and intraday low. Why does that occur? Well, because machines set prices. So machines will be putting buy and sell orders into the marketplace to profit on intermediating other people's stuff. It's 50% of market volume. And sometimes more than that. And what are those machines doing? Well, there are displayed trades. You could look at Lyft, and at any given time, I can look at my phone. Any given time, there are 3, 4, 5,000, 900, 5,000 shares at the bid to buy or offer to sell. But below that, there's a lot more. If let's say, for instance, today, index options expired at noon Eastern time. And so those tie to big baskets of stocks, and there will be proportionate demand for things in the basket. What if it's the triple Q that Lyft is in? Well, I'm going to know something about the supply-demand balance. So do all the machines. Machines are going to go sift through all the stuff that's displayed. There's the displayed buying and selling, and then there's the undisplayed order flow. All the exchanges have it. Exchanges have hidden orders. So I could say, I'm going to put 500 shares out there to try to fill. But then I've got 250,000 shares that I've hidden at different prices. Well, machines are going to be going through, trying to trip them, trying to trip your stops and limits. Happened to me yesterday. I had a long trade in TQQQ. I thought, well, that's a pretty good bet. And so I put a stop and a limit in it because I had to do some yard work. And so while I'm doing the yard work, it took out my stop. Now, my stop was $1 higher than I had bought it at, so I made plenty of money on it, but I was disappointed by that, right? You don't want to get your stop taken out. I didn't expect that it would move down there, but it did, right? That happens because machines are going to move through, trying to find people's orders. This is why I say you have to be careful about those things. Anything that you put into the food chain in the form of a stop or limit, there is the possibility it will get tripped because machines are going to look for those things. But what we're trying to do is, in this environment, give ourselves the absolute best chance of producing a good return. And so, I look at Lyft, and here's your entry range based on where it closed yesterday, and taking a third of the volatility. If you took a third of that volatility down, it would be around 1728. Well, I don't want to go that low. But today, before I left Denver, I put in a stop at 1735. I don't want to lose that kind of money because my cost basis was considerably higher than that. I don't like to lose money like that, but you have to be willing to risk some part of the volatility because that's how the market works. How much am I willing to risk? 2 to 2.5%. That's it. So long as I know that I have a 70% chance of making 2% or better. The odds are in my favor, but I don't want to have machines trip me. So Karen ended up keeping an eye on it, and I exited out of my position in Silverthorne on the way here to Steamboat because I didn't want to hang around. But my thesis was absolutely correct. If you look at the supply-demand balance in Lyft, you would say, okay, options are expiring in indexes today, what's it in? Triple Q. Well, look at the supply demand imbalance. Massive demand, plunging supply. What is the probability that there is demand for that equity in the basket and that it will materialize somewhere in that time period around noon Eastern time to 2 Eastern time? Because then the new series will roll. And so if there's excess demand, well, where did it hit its high point today? These are just things to know. Right? It's right there. If you go look at the data, Lyft was at, I actually put my limit order in at 1843. Then I took it off, but that would have been a pretty good, I know what I'm after, right? I love consistent small gains with high probabilities of success. It's not stressful to do that, and I don't have to sit and watch things. But sure enough, it happened just pretty predictably at about noon Eastern time. That's where it's going to be. There's a run up into it. Then all those orders get satisfied because these are date certain events. Now the next time will be in December. And so then the price retreated some. But these are things you can know. This is what we understand. We understand options expirations. We understand supply demand imbalances, algorithms, the rules of the market. Where do things have to trade? Why? How? When? All of that stuff we know, and we're put in the platform so that you can use it to your advantage. And you don't have to do any of this thinking, really. I don't spend a lot of time thinking about it. I look at Lyft. I look at the supply demand imbalance. I like the price. At this price, I can buy a bunch and make a pretty good return, about 2,800 shares of it. Right? So, and I did it in a series, about 99, 99, 99 at the market. Why? Because those orders have to be filled at the best price. And then I stop. Now everyone thinks there's an algorithm buying Lyft, right? So the price will move up a little bit and then it comes back to me. Then I might buy 2,000 shares, boom, at the market because there's a 1 penny spread. That's it. You can look at it as a 1 penny spread. I'm going to get a half penny. Somebody's going to take a half penny filling my trade. And I sold it at a half penny today. So I sold the whole thing at the market, 2,800 shares filled instantly because there were 3,000 or 4,000 shares on the bid and the offer. So that works very well. I use the entry and I said, okay, I want to make 1 to 2% on it because I'm not going to be able to watch it. I'm driving today and I'm going to put I'm going to set my target to sell it in there somewhere north of 18. And it could be as high as 1848. And it got pretty close to that, didn't it? All right, well, that's really, really good math. It works well. I don't sit and think about it just like Henry. I look at it, I make the decision, I execute the trades. And I like to do it at the end of the day and then the first thing in the morning because, see, every day is a new day for high-frequency traders. They have an investment horizon of a day or less. Fast traders is what we call them on the platform. And so every day is a new day for them. Well, you and I know if we bought it the day before because there's supply-demand imbalances, the probability is definitely in our favor that the stock is going to move some proportion of the volatility that we know in Lyft is 5.7%. And how much am I after? 2%. Well, the very high probability that I'm going to get that. So those are the things we think. That's what I do over and over and over. I traded a firm. I got stopped out of one stock, Taylor Morrison Homes, TMHC. I didn't have much of it. Who cares? I know that there's a 68% probability that I'm going to make money and a 30% probability that I'll get stopped out of something. But when I do put the math together, again, over the trading 10 days in the last month made 5%. That is exactly what I'm after. And if you can do that over and over and avoid the periods where there is risk, it is just a great way to approach the equity market. And these probabilities work very well. So the next thing that I'm thinking about, so that's basics, entries, exits. You want 2%. You have to be willing to take certain risk. The volatility of the market is about 2.5% currently. Long run, it's about 2. Well, you have to realize that's the risk you're going to have to take. But when you have a supply-demand imbalance, it's going to work in your favor most of the time. Now, the next thing, options expirations. Why are these risky? Forrest, to your point about HIMS, why would it drop 25% because Amazon is in the market? Is it suddenly worth 25% less just like that? What if Amazon fails? Well, that's not the issue. The problem is 20% of HIMS market cap ties to derivatives that are renewing tomorrow. And then they settle over the weekend and new ones trade on Monday. Well, that can all get marked to market. The opposite thing can have. Shopify was up 20% on earnings, corporate customer of ours. Why would that happen? Well, people have big bets on lapsing derivatives, and all of a sudden those things spike in value. Boom, the stock runs up. Well, those are things you have to know. It's why it's very difficult to trade things around earnings successfully. We don't have the horsepower that hedge funds do and their capacity to trade outside market hours and make returns on those. So beware, at options expirations, things can get marked to market. Things can move violently. And so, we track that stuff. You go to marketstructureedge.com, click on resources, and you'll see the calendars. And so I'm thinking now, if I think about what's next, as Henry noted, we're getting very close to that red line. If you did a daily volatile read, it's 6.8 already. It's already over that red line. You say, well, why wouldn't you put that on the platform? Because a daily read isn't a central tendency. We use central tendencies everywhere because the market is full of those. The market is about average prices, volume weighted, time weighted, pegged, floating. The whole market is built around averages. BlackRock, Vanguard, and State Street, they're after averages. Beta, the movement of the market, not alpha, outperformance. So we have to think about those things. But I know now that the supply trend is starting to change. The demand trend is getting very close to the red line. Options are expiring. I'll show you another little data point. And look, if we could, in time, we're very careful with our resources. As we have the resources, we can add these capabilities. But we have all this stuff behind the scenes. There's almost nothing we don't know about what's occurring in the equity market. So if I look at the S&P 500 over the last 20 days, green bars are when there is net buying. Red bars are when there's net selling. Despite the incredible run here with the election, the Trump trade, there are really only 5 net buying days in the S&P 500 in the last 20. It's unbelievable. Of course, we can see what patterns are responsible for it. Green bars, passive money, BlackRock, Vanguard, State Street, all your and my 401ks getting deployed into target date funds and weighted and asset allocation funds and low volatility funds and all that stuff. Well, where do those things get trued up? At options expirations. So I'm looking at that. I don't even have to look at it. I'm sharing with you that behind the scenes, when we're writing notes, we have a lot of data at our fingertips that we're incorporating. But I can look at this and say, the next thing I will be looking for is a possible short. I'm not saying that you should do this. I think you have to be very comfortable with trading to do it. But I use those instruments periodically when the conditions are right. If demand goes over the red line and supply continues to rise and it's options expirations, I may look to short the market. It's risky. Earlier this week I had a trade in a volatility trade, a trade in a firm which I hedged, AFRM. It's a great stock to trade, but it can move a lot, and a long short trade. 2 times long, 1 time short because demand in the broad market is rising, but it protects me. And then what do? Well, if things move in your favor, you sell your long hedge, I sold a firm, and then I've waited, and the market came back down. I was actually able to sell my short hedge at a profit because it was in SQQQ. Tech had trailed a little bit. You can do those things, but it all comes back to understanding market structure. What is the supply-demand imbalance, and where is it? So I look at this and say, there is risk. I've said this before. I'm a big fan of pro-business approaches in government, but I'm also aware that the market is way overdue for a correction. You have a lot of selling underneath what appears to be a very strong market. Index funds are overweight. A lot of money came out of the market in October. I don't see that it has all come back yet. So I look at these conditions and say, well, there's risk ahead. It might not be. If the market is very strong and we pop up to 7, there is a contrail. It has some staying power before it deteriorates. But I'm just going to watch that data. At this point, I'm going to be very careful now about long trades. Options expiring tomorrow, new ones Monday, Tuesday banks square the books, Wednesday volatility expirations. That's risky turf. I'm very happy to wait. If I like the data for a short, I might do it and I'll hedge it. But to go now, I'm going to be very careful about chasing momentum, even though there are plenty of opportunities. And notice those did very well. They don't necessarily hew to what you see in the broad market. Henry highlighted Reddit, WBD, which he showed there, CYTK, I think it was. All of them performed well. CYTK was a little weak, faded fairly fast, but they delivered exactly what the momentum portfolio indicated, and they'll be there. Just realize, like HIMS here, there's a thing that tripped it up. It was there in the momentum portfolio, and then something happens right during options expirations, and you get hammered. It's why those things you can't control. There are risks like that, and they get worse in options expirations because of the reliance of the market on derivatives. Okay, so that's everything I wanted to cover. The basics, why options expirations are risky, and what's next. What's next for me is I'm watching that data carefully, and I don't have any intention of trading a long position now because of expirations occurring right now. Okay, I will stop there. We can answer any question or wrap up. Plenty of market structure for 1 day, 1 week. Any comments? And feel no pressure. We just want to make sure we answer your questions.
Tim, I'm going to pull one thing up, and I'm going to, there's 2 points you made that I'm going to reiterate that I hadn't heard you say in 3 years, is basket demand around lift. That's a great point. Is even though it's options expiration, I'm recognizing that there has to be demand for lift, and there's only so many shares. So the probability that some basket out there is needing to add lift to its basket, that's a really prime trade. I just love that point you made. And then I wanted to just really quickly share this and ask what you make of it. Is as I look back on a couple years of data, and this is going back to 2022. Can you see my screen here?
Yep.
So here we are in August of 2022, right?
Mm-hmm.
And what we see in short vol, we have, pounding, sort of demand is just shooting sky high. In the meantime, we have this short volume. And what happens right here, I mean, I'd like to zoom in on it, but I know we're getting near time, is right here we have really low short volume, lots of demand, but we know we're totally overbought. And sure enough, we get this sell-off. I'm not trying to be, forewarning or anything. I'm just recognizing that what I'm realizing in some of the data is a lot of the time when we see, we'll focus further up here in the data, waning demand, this demand, we keep peaking lower. It's looking like we might peak even lower. To me, this is showing even this low demand around expirations. It's showing me that we don't have a lot of commitment at this price, long or short. When we ran this market for these couple of years, we had 50% short volume. Everybody's just tearing upwards. Yeah, we'll take our long positions, we'll hedge it short, and then we'll do it again. But here, when we really, I guess that's I'll frame it as a question. How much do you see that as a lack of commitment to either side?
So when I look at the supply and demand like that, I will couch it in context of monetary policy oftentimes, because it's so influential, and it will manifest there because of the very large scale global macro money that's in the market, all the the hedge funds that are in it, BlackRock's Aladdin system used by $20 trillion of assets to manage risk. If you think about the $45 trillion of assets at the 7 largest money managers, I won't rattle them off. They're all managing risk, and it manifests in the broad market supply and demand. And so if you look back in about January of 2022, the market anticipated an end to the easy money cycle and a period of rate hikes, and then we had that very difficult 2022. And then, the market did okay in the first part of 2023, but it was still very weak in September of 2023. And then the Fed said the era of rate hikes is over. And then we were off to the races. And we had a long-term, from February to July, downtrend in supply. Then in the lead up to the election, no one wanted to be short the market. There was clearly some belief that that Donald Trump would get reelected. And you could see that in the fact that shorting plunged. There was no question there was money removed from the market. We could see that in patterns and behaviors in the market. But that we've had that. So those are very global macro kinds of things. Now, the question then is there another global macro change coming? My thinking is we're going to get a dud of a jobs report at some point. You know, maybe it's the December jobs report. I said this in the summer, and then we had that weak jobs report. That I was communicating with some economists and saying, look, you look at the trend. We haven't added any jobs since September of 2023. In fact, in the last jobs report, if you looked at the household survey, it was a loss of 370,000 jobs. So do we have a bad jobs report and it changes monetary policy and the market corrects? I don't know. But to me, those are, you can see what the global macro money is doing by looking at the relationship between demand and supply. And momentum markets look different than normal markets. I'll wrap up with this. We've gone longer than I prefer to go, and I know that. So I won't take but just another minute or so, but I do want to show you this. So, you know, bear markets have weak demand that keeps dropping. You say, well, they're entry points. They always are. At the green line, you always have a long or short period where you have a chance to buy and sell. But this is a weak market. When demand spends a lot of time above the green line and part of the time above the red line, that is a strong market. Notice what the stocks did, right? And then we had weakness again, but there's a lot of white space in there. Well, it's a weak market. This is the end of the rate hiking cycle, and that happened October 31st, roughly. A huge amount of demand, and that creates a big run for stocks, and then a natural reset. You have to have mean reversion. But what kind of pattern is it now? Well, the thing is, we have not dropped below the green line. We've gone a very long time. You could go back and look historically, and these things end. It's Stein's law. If something cannot last forever, it will stop. And those conditions to me suggest that it will stop, and it might be pretty violent. And it won't matter, what the, how ebullient everybody may feel about the economic prospects of the country. There can be a reset. So it's just very telling to me when you look at these things. You can see what kind of market we're in. We are not in this kind of market now. We are also not in a bear market. We're sort of between, and we'll see how that plays out. But it's good to know.
Well, okay. And it's good to know we don't have to know all of it. We just have to trade tomorrow. Yeah.
Yeah.
Hey, Tim, just a quick one. I know you're trying to get shut down for the day, but on something like HIMS that went down like, I don't know, was it 25% or something today?
Yeah.
What, in a situation like that, the probability was 100%. But would you look at that with interest that it'll recover a fair amount? I mean, volatility was 10.4% normally. They went down 25% or something like that. So would you look at that and say, hey, I'm down 2.5 times volatility?
Yeah.
How would you look at that?
I wouldn't touch it with a 10-foot pole. As Forrest made that point too. Even though, do I think that there's a chance that it pops tomorrow? Yes, because there are options that have 1 day of time decay left. That's it. That people could buy en masse today, pennies on the dollar, and try to push those into the expiration tomorrow to get people to cover. But that is a very risky trade. If I'm a hedge fund, I could do that. As a retail trader with inferior data and leverage, I'm not doing it into options expirations at all. If we were the other side of expirations, I would look at that differently, because then you got 30 days of time decay. What's the risk and probability that money returns? I'd still want to look at supply and demand. I mean, I'll go to add lift back into this equation as part of the answer. Price doesn't mean anything. I say this to people all the time. Do not trade price. Price is capricious, and it does not reflect what machines are really doing. Trade volatility and demand and supply. So if it's gone down twice its volatility, I'm not touching that. Now all bets are off. Machines don't even know how to trade that, right? The machines depend on the predictability of the historical data set to know whether to make bids and offers and to be long and short. Citadel does not want to lose money. They almost never do. And so in situations like that, the prudent would foresee evil and hide themselves. Just stay away from it, even though it could bounce tomorrow.
Yeah, just curious. Thanks.
Yep. Okay, everybody, we took you way long, and so we'll only do it 25 minutes next week to to give you back some time. Appreciate your patience. Good to see everybody. Thanks for being here. We'll do it again next week.